Hi, everybody. I'm Lynnette Khalfani-Cox, the money coach.
And I'm Teri Ijeoma, the founder of Trade and Travel.
And this is Make It Make Sense, the show where we break down everything you need to know about different investing topics.
And today's topic is day trading. I'm so excited.
I know you love this. This is your thing, your baby here.
So what is it? Day trading is taking advantage of short-term moves in a stock price in order to make a profit. Now, what does short-term moves in a stock price mean? Well, there's actually a study called the average true range that will tell you how much a stock usually moves on average in a given day. So for me to break this down and really make it make sense, let me give you some examples of how much some common stocks that we talk about or know about move in a day. So when I think about like Apple, and this is as of like end of April, these numbers will change as they go. So that's why I had to give you kind of a timestamp on that. But Apple moves about $2.65 if we were to look at the last 14 days. AMD, on average, its average true range, moves about $3.24. Amazon, its average true range, and we have to note that at the time I'm reading this to you guys, earnings just recently came out. So anytime there's a big move in a stock price, it's going to affect the average true range. But let's just go with it for now. So right now, Amazon's average daily move is about $67.21. So now, why is this important to you? When I say that a stock moves $67.21, now let's think about like, what are your personal goals? What if you needed to pay for daycare and your daycare bill was $600 a month? Well, if Amazon moves $67 in a day, what if you had 10 shares of Amazon? 10 shares of Amazon that just moved $60. That just paid your $600 daycare bill. So that's what we're doing as day traders. A day trader is just taking advantage of the daily move in a stock and getting profit in that day. Now, here's the thing. I'm stuttering a little bit, but I'm actually so excited about this. Like, that's why I'm like stuttering. So day trading is a subset of active investing in general. So active investors, we are traders, like we are buying and selling stock or options or whatever asset class, but we are buying and selling it actively within less than a year in order to have income. So the government, when we're classified as an active or a pattern day trader or a pattern trader, we're somebody who is actively trading for income. That means the same way that you go to work and you're getting paid a salary from your job, we are going to work in the market and we're getting paid in the market. Like we are finding a way to get our paychecks from stocks. Like that's what we're doing when we're an active investor. And so later you might say like, well, Teri, why would you want to do that? Well, because if I have a goal that needs to have money right now, active investing will pay you right now. So that's what it is. Now we go into like, well, why does this matter to you?
Yeah, and it's really a great thing to think about why active investing or trading matters, because you kind of outline some of this right off the bat in terms of helping you to reach your goals. Daycare, those of us who have kids, my oldest is 23 and my youngest is 15, so they're not in daycare anymore. But college costs, Believe me, I have one recent college graduate, a 21-year-old who's in college, and a 15-year-old college-bound teen. So yeah, I got college on the brain. Why does it matter? If I could trade and get money to be able to pay for their college education and reach their goals, ka-ching, I'm all ears and I want to know about what to do. So I think that the main reason that it matters is that trading is a skill that you can learn to make money. I mean, to do any kind of thing that you want to do. Maybe you want to pay off debt. Maybe you want to build your savings for something specific, like buying a house or whatever. If trading lets you do that in short-term increments and take advantage of that, then hey, I'm all for it. Can I say one other thing though? Because as you were speaking, Teri and I had been having this ongoing dialogue, this sort of jokey joke about her being short term and me being long term. And I've been like, okay, pull me along. I'm trying to learn. I'm trying to do a lot more trading. But something you said actually sparked an idea in me about the taking of profits along the way. And you were comparing essentially what a trader does, a short-term day trader or swing trader versus long-term. And you were saying like, you can keep taking your profits along the way and you're just actively taking those profits. And then I started thinking about it and I was like, well, yeah, even though I'm kind of a long-term investing gal and have been for years, that's been my thing. But I do actually buy a lot of ETFs, a lot of exchange traded funds. And exchange traded funds are kind of like mutual funds. They have a different kind of a wrapper, if you will. But really, one of the main differences between ETFs and mutual funds is that exchange traded fund is actively traded throughout the course of the day.
It's traded like a stock.
It's traded just like a stock.
Yeah.
And so whereas a mutual fund is based on the value at the end of the day, and it only has one price point at the end of the day that is being considered, the ETF, that price of that particular stock, really, which is a whole bunch of things that's built into the ETF, it's actively traded all during the day. And I'm like a big Kathy Wood fans. I own so many ARK funds.
Shout out to the ARK fund.
And they're all ETFs. And so really, I am like more trade through that, trading a lot more. Somebody else is picking it. Obviously, I totally get it. Teri looked like, don't even try to say that.
You're still buy and holding with those. Or have you been selling it?
I'm gonna tell you. Hey, I'm trying to make it make sense. I'm trying to be truthful too.
Okay, go ahead.
No, I have not, because I am looking at it like I have conviction, just like she does. That I'm like, okay, these are things that I'm invested in for the long term.
Okay.
Biotech and EV and et cetera, et cetera. And I'm like, I don't need the money right now, but I want to know, can I just put it to the side and not think about it? And yeah, if I'm going to put X, $100,000 into something, if I look up and 5 years later, it's 700,000 or X amount, I'm going to be happy and I'm not going to care as much. But I hear you. Go ahead. Tell me why I need to be trading. Tell me why I need to be taking some profits. I know. I think you guys have gotten that in this season, in this series, right?
Right. Okay,
Lynnette needs to learn how to trade better. Okay.
Yes. Well, and the thing is, she's in trade and travel. She's one of my students, so we've got to like work on this because you can't be like a trade and travel student and not trade. Like that's
no,
one
but
of the words.
I definitely have traded and taken profits. Okay, for sure. But what I'm trying to say. What happened was, what I'm trying to say is that when you were explaining about like just taking the profits on the way, I don't know why, but a light bulb went off. And I was thinking about all these ETFs that I own, which really are the actively traded versions of regular mutual funds, which is, again, what I started with. You know, I used to be a financial journalist. So I was a Wall Street Journal reporter. I was a CNBC correspondent. And we had restrictions on some things and what we could buy in the stock market because we were covering certain companies. And so you couldn't invest in individual companies directly. So I started like, okay, I will buy some mutual funds. Yeah. And I would buy funds. But, you know, now from a fund perspective, most of mine are ETFs.
Yeah, and those move too. So, like if I look them up real quick, I'm gonna tell you the average true range.
Not as much, but they move.
No, they move a lot. Yeah. Like so some of the ETFs. So we talk about exchange traded funds. Oftentimes they go by sector. So like some sectors that I've been looking at is this.
Which one?
No, consumer discretionary.
Oh,
is what I was trying
discretionary.
to say.
Okay,
I was
yeah.
like, wait, how
I didn't know where you were going. I was
Like,
trying to
wait,
catch you here, but I didn't know this
was like, wait,
something.
wait.
Discover
Consumer
the financials?
discretionary.
Okay.
But like its average true range is $2. So there's one that a lot of people trade called XLY. It's
Yes.
a spider ETF.
Spider, yep.
And it trades $2.31. That's another way to play Amazon and Tesla because it's both in that XOY. Then you got like the XLK, that's the technology ETF, but it trades like a stock. So this is another one of Kathy Wood's. It's an ARC-X. But
I'm in that one too.
You're in that one? So this XLK, the technology one, it moves about $1.89 a day. So if you're just thinking about, okay, if I had 100 shares of this, I'd make about $189 a day. Well, just think about it. If you make $100 a day, that's $500 a week, an extra $2,000 a month just to buy. And there's different ETFs. So like maybe like you're trading technology, but you can trade it in a different ETF. But the one I'm looking at now is XLK. But just think, like, if you're making $100 a day, that's an extra $2,000 a month. That's good money. That's an extra $24,000 a year just by making $100 per trading day. And this is not to say that every single day you'll do that, but usually it's an average. So there might be some days where you have some losses. There might be some days where you don't make any money, but then there's another day where you make $300. Well, now you're still back to your $100 a day average. So that's what it means to day trade. Now, I will tell you the truth. There is a difference between day trading and swing trading. And I actually do both. So you don't have to trade every day. Like you can get a swing trade as if you buy a stock one day and then you sell it the next day, 2 weeks. Anything less than a year is considered a swing trade. Like what I do is I'm a technical analysis trader. So I'm looking at the chart to tell me when to enter and exit a stock. If it says exit within a day, then I'll do that. If it says exit and I don't get there for another 2 weeks, then I'll wait for the 2 weeks. So it really will depend on the chart to say how long I'll stay in a stock. But the thing about it is we're just talking about like why you would do this. It's because those small gains start adding up. Now, here's the question I was going to ask you with your ETFs. You ready?
Oh, Lord. I suppose I'm ready, but yeah.
So if we're talking about make it make sense, one of the questions you asked me before is like, Teri, if you really want to keep a stock for the long run, like I've been in Amazon since it was like $199 in and out of it. Apple since it was like $100 before its several splits, right? And the question you asked was, well, why don't you just keep it then instead of getting in and out of it? So tell me this, with your ETFs, are they all doing well right now, or have you seen some declines in them?
No, I've seen substantial declines since February. In the last 2 or 3 months, it's been ever since, the value play kind of came into favor and growth kind of went out of favor as interest rates became a worry, people thinking about what's happening with the 10-year and people worried about inflation, a lot of growth went out of favor. So since then, no, they've all been down. So before then, they were all like, woohoo, flying high and doing great. So nobody believed. The Fed is like, don't worry, we're not going to raise interest rates. We know the economy is going to run a little bit hotter. We're worried about full employment. But Wall Street didn't believe it. Wall Street was like, well, look at inflation. They're going to raise rates. They're going to raise rates. Look at what's happening with the 10-year. And the Fed is like, no, we literally said at least until 2023, we're not going to raise rates. And the market keep going, but in the past, you raised rates. Like when this happened, you raised rates. So, that's the short answer to your question. They were doing extremely well. And then the last 2 to 3 months, not so much.
Got it.
So, yeah.
So, like, let's just make up some numbers. Okay. Let's say that coming into the end of the year, you had like $30,000 worth of gains, profit. Mm-hmm. Now, after the last 3 months, you've lost $10,000 or $15,000 of that. Mm-hmm. The reason why I am an active investor is because instead of just having to sit and wait for my account to lose that 15, I would have wanted to sell it when it was higher and then gotten back into it when it came down 15% or 15,000, instead of having to just like watch my account go down and then watch it come back up.
Right.
And we call that locking in a profit.
Right.
Because if you sold at when you were up 30,000 and then it comes down 15 and you get back in, you just locked in that $15,000 of profit. Because now you're still back in the same stock and you can ride it back up again and get your money back.
Right. And I understand the logic of that, and I understand the math of that, because like literally any stock, and I'm really good at math, okay?
She's very good at math.
Like any stock that loses, say, 50% of its value has to have 100% gain just to quote unquote break even. So I get it that it's a hard slog to get back. I guess for me, the main thing has been like, okay, I'm going to commit and put time in the market. I'm not as excited about timing the market. And because I just rather like not look at it and not think about it and say, is this the right time or not, and go back and forth, I've not committed the time. And honestly, it's really not like it takes a lot of time. It's because it's really not. Once you set up systems and you can have alerts, you can have stop losses, you can have a whole bunch of things electronically to do the work for you. And that's one of the things that I learned in Teri's class. So it wouldn't have to be, but the fact is, from the last, year plus when I took her class, we had a pandemic, I'm trying to run a business. I got kids, I got a husband. And so I'm like, my time is precious. So,
but now her husband looks at the stocks for her.
That's true. But I get it that taking and capturing some profits along the way does not preclude you from having the opportunity to get back in.
Yes.
So my take on it over the years has basically been like, okay, like when do you get back in? And I know now from having taken your course about being able to find an entry point and make sure that you're getting the right size, position, etc.
Yeah,
so I get that. So I get that part of it. But overall, my philosophy and thinking was, okay, I'm going to, if it's something that I believe in, for the most part, since I'm a long-term investor, I'm going to keep this and ride it back up when and if it, and I haven't had really losses, honestly, just because for being a long-term investor. However, I do recognize the main downside from my strategy, which I think is what you're telling me here, is opportunity cost.
Yeah.
So the fact is, yes, the stuff that I've held and done, and by the time I sell it or use it or liquidate something, I made a gain out of it. However, it might have been a year to get back to where it was, and that capital could have been used elsewhere, and it could have been earning additional money elsewhere, put into another alternative investment. And that's really where trading trumps long-term investing, because you're taking advantage of those price variations on a continuous basis.
Yeah. Like we even think about Bitcoin. I'm not super advanced in Bitcoin. However, I have been trading it lately. So like it rose to $64,000.
Talk about volatile. Yeah.
Yeah. It rose to $64,000, and then in the next week it came down to like $49,000.
It dropped like 30%.
Yeah, 14,000 per coin. Well, the cool thing is, because I'm a trader, I actually sold at 64,000 and then was able to buy back in when it came back down. Like for me, that's the like essence of being a trader.
And so, okay, and can I say, I totally get that. I just want to give one little counterpoint, one little shout out to the little slow ones like me who've been like slogging along here with our long-term investing plan. So yes, you got back, you sold at a high point. Good for you. That was great. And you have a strategy, and obviously a strategy that works, and that's like better than what 99% of people out there are going to do. So part of the other reason why I would do a long-term investing strategy and say, okay, if I like this stock, if I believe in the company or the industry, is that I'm dollar cost averaging. So dollar cost averaging basically means buying shares at a lower average price point over time. So if I'm saying, okay, I'm going to invest $1,000 a month in the stock market or in a given fund or something that I want to keep adding a position to, again, I might buy it at a lower price point. I might catch it on the decline and at any given month. You might say, okay, the 5th of the month, I'm going to commit and invest my money here. But by dollar cost averaging, you're being consistent as an investor. You're committing a specific amount of time or a specific amount of money at the exact same time, more or less, every single month, right? And so the thinking is that over time, you're buying more shares at a lower overall average price point. So I am able to capture, some of those when they come back on the decline. I'm getting those shares at a lower price, and thus, the returns are there. But it ain't no Teri Ijeoma returns. I will be candid about that, okay? Let the record show my girl is out here killing it. So,
yeah.
And you can't argue with results. So I'm not trying to argue with you. So
no, it's okay. It's okay.
Like, it's okay, little girl. You'll catch up soon.
No. So the thing
teasing.
is with dollar cost averaging, I think that's important. Like if it comes down and someone's already in something and they want to keep holding it, that is important. Knowing how to be able to get back in when it's lower.
Because you're buying more shares at a lower price point. So it's knocking down your average cost over time. Yeah.
It is. Only part that comes into play with that is when people don't know when to let it go. Like if they had have been able to let it go when it was higher and not just sit in it when it comes down lower, that's where I get nervous because it's kind of like you could have
let it go.
Yes.
Let it go.
I was going to try to start with you.
I will never get a singing contract.
Me neither. But I love Frozen. Yes.
Just don't let your assets get frozen, okay?
Right. That part. Yeah. And it's just don't get greedy. So one of the biggest things about being a trader is when you do see some gains, you have to learn how to let it go.
Yes.
Because if you don't, then you will be stuck in a position where you have to dollar cost average because you still are holding on and it's losing. Versus if you had let it go when it had made some money, then you could still buy back low, but now you're getting into a new position where you have ability to make more money on that.
Yeah.
So yeah, that's
absolutely true. Something that comes to mind is something that a legendary investor told me, Charles Schwab. I mentioned that I used to be a Wall Street Journal reporter and a CNBC correspondent. And I wrote a book called Investing Success: How to Conquer 30 Costly Mistakes and Multiply Your Wealth. Yeah. Well, I interviewed Charles Schwab. He wrote the foreword for the book. Book did very well. And I asked him, I said, listen, have you ever made any investing mistakes? And he was like, are you kidding me? He said, I've made enough mistakes to fill 3 books. And one of the main mistakes that he said that investors make is not knowing when to cut their losses, not knowing when to say, okay, enough is enough. Admit you made a mistake and move on.
Yes.
So I hear you on what you're saying there, and I totally get that.
Mm-hmm. So yes. So now that we've given our 2 cents about it, so how do they get started? So first, I think it's really important for you when you're getting started to do your research and get educated. Of course, we know I have a course, but it's important to just learn more about investing before you just start to plunge in, because that's what I hear a lot of people do. They just try to, they try to start and they don't know what they're doing.
Now, okay, Teri, you sit up here being modest, girl, but I'm wing girl here for a second, because she's being real modest. Y'all heard her just say, "Oh, yeah, of course I have a course and blah blah blah," and then she just kind of kept it moving. No, she has a phenomenal course on trading. So anybody out there who's listening and watching us, anybody who's never even heard of us, okay, I'm gonna tell you the truth. Teri Ijeoma, she has a course that's teaching people how to make $1,000 a day trading. Yeah, I said $1,000 a day. Okay. And so, and I know that, I know the goal is to make 1% per day. Right. And so, but a lot of people who are doing her VIP class, those folks are really killing it. That's the next level. That's what I need to be doing because I haven't even started it yet. But that class is for people who want to learn about options trading, about short selling, about the strategies where you can make money in any market. And so, yeah, let's not just gloss over like, oh yeah, I got a little course. Getting started, you need some help, some advice, some strategic information, and some expertise. This the girl right here, Teri Ijeoma. She out there killing it, y'all. I'm telling you, okay? So
Thank you.
You're welcome. No, I wasn't going to let you get past that, so...
I thought you were going to tell them about the Teachable Award.
Oh, well, that too. Oh, yeah. So look, no, this is phenomenal. And I know people, I like to, give my sisters their props and their flowers right now, okay? So Teachable is an online learning platform. A lot of people who teach different things through courses do so through this platform called Teachable. And there are thousands and thousands and thousands of instructors and courses and content creators on Teachable's platform. Well, who had the #1 course on Teachable? Teri. I was like, oh my freaking God. Like, girl, you really out there killing it. So that speaks volumes because the reviews are there, the ratings and the rankings and the accolades and the feedback and the positivity and the people who are saying, this actually works. Like, she taught me how to make $1,000 a day. She has a club, her little members in the club, people with their little, I see them they be posting on Facebook. I joined the club. They show off their stuff, show their accounts and whatnot. So this is real deal, you guys. And I'm telling you, so for those of you who know me and my brand, as a money coach, I've had my business for 18 years. I started my company in 2003. I don't say stuff that's not true. I'm not going to tell you something that's not going to be authentic and real, that I wouldn't give the same advice to my mother, my sisters, anybody that I know, trust, or love. And I'm telling you, it's real deal with Teri. And so if you want to learn about trading and you want to get started, this is a good place. So,
aw, thank you.
You're welcome. So,
can I give you a hug?
Yes, of course. Hey, I want y'all. Oh, well, don't fall. Don't fall. And in case y'all wondering, we have had our vaccinations.
Yes,
We're fully vaccinated and immunized. Mm-hmm. So I told her when we came and shot, I was like, you're the first person that I got to hug in 14 months.
Yes.
Besides my husband and kids.
Very true. Well, thank you so much.
You're very welcome. And I thank you guys for watching this series. And we hope that this has definitely opened your mind and your eyes and your vision for the prospects of what trading, day trading, or swing trading can do for you. And I hope that we've made it make sense.
Yes.